When the math stops working, the promises become lies. On September 28, 2022, the Illinois Teachers' Retirement System conducted its annual actuarial review and discovered something that would have been mathematically impossible just 2 decades earlier. Despite collecting contributions for 43 years and managing what appeared to be a substantial investment portfolio worth $62 billion, the fund was mathematically insolvent, not temporarily underfunded or experiencing investment losses, but permanently unable to meet its obligations, even under the most optimistic scenarios for future returns and contribution increases. The actuarial analysis revealed that the fund's liabilities exceeded its assets by $139 billion, creating a funding ratio of 30.8%. But the true mathematical horror wasn't the current shortfall. It was the realization that no combination of realistic investment returns, contribution increases, or benefit modifications could restore actuarial balance. The mathematical relationship between promised benefits, available assets, and demographic realities had reached a point where solvency had become arithmetically impossible. Illinois wasn't experiencing isolated mismanagement or temporary market conditions. It was discovering mathematical reality that pension systems worldwide were simultaneously confronting. The fundamental arithmetic underlying defined benefit pensions had been violated so completely that the promises made to millions of workers had become mathematically unkeepable, regardless of political will or economic performance. This wasn't the first pension fund to face mathematical insolvency, but it was among the largest and most sophisticated, with professional management, diversified investments, and decades of successful operations. If Illinois teachers could become mathematically insolvent despite apparent financial strength, it meant the mathematical foundations of pension systems had deteriorated beyond institutional solutions. The mathematical basis of pension systems requires a delicate balance between 3 variables: contributions from workers, investment returns on accumulated assets, and benefit payments to retirees. When these 3 variables maintain proper mathematical relationships, pension systems can operate indefinitely. When the relationships become unbalanced, pension systems enter mathematical death spirals that make insolvency inevitable, regardless of management quality or policy interventions. Historical pension systems succeeded because they were built on mathematical relationships that reflected demographic and economic realities of their time. Workers contributed for 30 to 40 years, while life expectancy after retirement was 10 to 15 years. Investment returns consistently exceeded inflation by substantial margins, allowing modest contributions to grow into substantial benefit payments through compound growth over decades. These mathematical foundations remained stable for nearly a century, from the 1930s through the 2000s, because demographic patterns and economic conditions supported the arithmetic relationships on which pension promises were based. Pension actuaries could make reliable calculations about contribution requirements, benefit sustainability, and investment return expectations because underlying mathematical parameters remained relatively constant. But beginning in the 1990s, all 3 mathematical pillars supporting pension systems began deteriorating simultaneously in ways that made traditional actuarial calculations obsolete. Demographics shifted from pension-supporting population pyramids to pension-destroying inverse pyramids. Investment returns began declining from historical norms toward levels that made pension arithmetic impossible. Benefit promises were expanded beyond what demographic and economic mathematics could support. The demographic transformation represents the most fundamental mathematical challenge because it cannot be solved through policy adjustments or management improvements. When pension systems were designed, typical demographic patterns included high birth rates, substantial population growth, and limited life expectancy after retirement age. These patterns created mathematical ratios of workers to retirees that made pension financing sustainable. Current demographic patterns have reversed every mathematical assumption underlying pension design. Birth rates have fallen below replacement levels across developed economies, creating declining numbers of working-age contributors. Life expectancy has increased dramatically, expanding retirement periods from 15 years to 25 or 30 years. Population growth has slowed or reversed, shrinking the worker base supporting retiree populations. The mathematical impact of these demographic changes creates exponential rather than linear stress on pension systems. When worker-to-retiree ratios fall from 5:1 to 3:1 to 2:1, each active worker must support exponentially greater retiree benefit obligations. The mathematical progression makes pension financing impossible beyond certain demographic thresholds, regardless of contribution rates or benefit levels. Illinois teachers' retirement system demonstrates this mathematical impossibility through workforce demographics that violate pension arithmetic. The system currently supports 2.1 retirees for every active contributing teacher. Each active teacher's contributions must fund not only their own future benefits, but also continue supporting more than 2 current retirees whose benefits were calculated based on historical assumptions about worker-to-retiree ratios. This mathematical relationship cannot be sustained at any realistic contribution level. If active teachers contributed 50% of their salaries to the pension system, the arithmetic still wouldn't balance because the demographic ratio violates the mathematical foundations on which pension calculations are based. The promises made to current retirees were calculated assuming each retiree would be supported by multiple active workers, not the reverse. The investment return component of pension arithmetic has deteriorated simultaneously with demographic changes, creating compound mathematical stress that exceeds what pension systems can absorb. Historical pension calculations assumed consistent investment returns of 7% to 8% annually over multi-decade periods based on economic conditions that prevailed from the 1950s through the 1990s. Current economic conditions make such investment returns mathematically impossible through conventional portfolio management. Government bond yields, traditionally the safest component of pension portfolios, now provide returns below inflation rates, creating negative real returns that systematically destroy rather than build pension wealth. Stock market valuations have reached levels that mathematical analysis suggests cannot produce historical return rates over coming decades. Illinois teachers' pension portfolio demonstrates this mathematical impossibility through return assumptions that contradict current market realities. The fund's actuarial calculations assume 7% annual returns over coming decades, while investing in portfolios that mathematical analysis suggests cannot produce returns exceeding 4% to 5% annually under current conditions. This 2% to 3% gap between assumed returns and achievable returns creates exponential damage to pension mathematics over 20 to 30-year periods. Compound growth operating at 4% rather than 7% over 30 years reduces accumulated wealth by approximately 60%, making pension obligations mathematically impossible to meet, even if demographic ratios remained favorable. The combination of adverse demographics and reduced investment returns creates mathematical impossibility that cannot be solved through incremental policy adjustments. When worker-to-retiree ratios deteriorate while investment returns decline simultaneously, pension systems face exponential rather than additive stress that overwhelms traditional actuarial management techniques. CalPERS, the California Public Employees Retirement System, provides another example of mathematical insolvency disguised by accounting conventions that delay recognition of actuarial impossibility. Despite managing assets worth over $400 billion, CalPERS faces mathematical obligations that exceed $600 billion under realistic demographic and investment assumptions. CalPERS maintains official funding ratios above 70% through actuarial assumptions that contradict mathematical reality. The system assumes 7% annual investment returns while holding portfolios that cannot mathematically achieve such returns under current conditions. The system assumes demographic stability while serving populations with worker-to-retiree ratios that continue deteriorating annually. The mathematical gap between CalPERS's actuarial assumptions and achievable reality creates unfunded liabilities that grow exponentially rather than linearly. Each year that actual returns fall short of assumed returns, the mathematical shortfall compounds through relationships that make future solvency increasingly impossible. Private sector pension systems demonstrate identical mathematical patterns because they face the same demographic and investment return challenges that affect public sector systems. General Motors' pension obligations contributed significantly to the company's bankruptcy because mathematical realities made pension promises unkeepable regardless of corporate profitability or management efficiency. GM's pension mathematics reflected broader economic relationships that had made automotive industry pension promises sustainable for decades, followed by mathematical changes that made the same promises impossible to maintain. When GM was supporting 10 active workers for every retiree while earning returns that exceeded inflation by substantial margins, pension obligations were mathematically manageable. By 2008, GM was supporting fewer than 2 active workers per retiree while earning investment returns that barely exceeded inflation rates. The mathematical transformation made pension obligations larger than the company's market capitalization, creating mathematical impossibility that bankruptcy law couldn't solve because the underlying arithmetic remained unchanged. Corporate America has largely abandoned defined benefit pension systems in recognition of mathematical impossibility that public sector systems continue denying through accounting methods that postpone rather than prevent actuarial reckoning. The shift from defined benefit to defined contribution pensions represents acknowledgement that mathematical relationships supporting traditional pensions no longer exist. International pension systems demonstrate that mathematical insolvency represents global rather than national phenomenon. European pension systems face identical mathematical challenges from demographic transitions and investment return deterioration that make benefit promises arithmetically impossible to maintain. The German pension system illustrates mathematical progression toward insolvency through demographic changes that violate actuarial assumptions. Germany's birth rate has remained below replacement levels for decades, while life expectancy has increased substantially, creating mathematical ratios of workers to retirees that make pension financing impossible at sustainable contribution rates. German pension contributions now consume over 18% of worker wages, while providing benefits that mathematical projections suggest will decline substantially over coming decades. The contribution rates required to maintain current benefit levels would exceed 25% of wages, creating mathematical burdens that would make German labor uncompetitive while still failing to achieve actuarial balance. Japanese pension systems face even more severe mathematical challenges because demographic transitions have progressed further toward ratios that make pension arithmetic impossible. Japan's worker-to-retiree ratio has fallen to levels that require impossible contribution rates or unacceptable benefit reductions to achieve mathematical balance. The mathematical progression toward pension insolvency operates independently of political systems, management quality, or economic policy because it reflects demographic and financial mathematics that transcend institutional solutions. When demographic ratios reach certain thresholds while investment returns fall below certain levels, pension systems become mathematically impossible regardless of political will or administrative competence. Understanding pension system failure as mathematical inevitability rather than management problem provides insight into why reform efforts consistently fail to restore actuarial balance. Political reforms that adjust contribution rates, benefit levels, or retirement ages cannot solve mathematical problems that exceed the parameters within which such adjustments can operate effectively. The mathematical requirements for pension solvency under current conditions would require contribution rates, benefit reductions, or retirement age increases that exceed political feasibility. Workers cannot contribute 40% of wages to pension systems while maintaining living standards. Retirees cannot accept 60% benefit reductions while maintaining retirement security. Retirement ages cannot increase to 75 while maintaining reasonable work-life balance. The mathematical impossibility creates political impossibility that prevents pension reform from achieving actuarial objectives even when reform efforts are implemented successfully. The arithmetic requires changes that political systems cannot deliver, making pension insolvency inevitable regardless of reform quality or implementation effectiveness. Federal pension systems face identical mathematical challenges with even greater systemic implications because government pension failures affect broader economic and political stability. Social Security represents the largest pension system in human history, with mathematical problems that dwarf state and local pension difficulties. Social Security trustees acknowledge that the system faces mathematical insolvency within 12 years under current demographic and economic projections. The trust fund reserves accumulated over previous decades will be exhausted by 2034, requiring immediate benefit cuts of approximately 25% unless contribution rates increase dramatically or economic conditions improve beyond realistic expectations. The mathematical challenges facing Social Security reflect identical demographic and investment return problems affecting all pension systems, but at scales that make solutions politically and economically impossible. The contribution rate increases or benefit reductions required to restore actuarial balance would affect over 60 million current beneficiaries and 180 million current contributors. Social Security's mathematical insolvency creates systemic economic risks because the system represents foundational retirement security for most American workers. Unlike corporate or state pension failures that affect specific employee groups, Social Security failure would affect virtually every American family simultaneously. The timing of pension system mathematical failures suggests coordinated rather than isolated breakdowns because all systems face identical demographic and economic pressures simultaneously. The mathematical progression toward insolvency operates according to demographic timelines and investment cycles that affect multiple pension systems concurrently. This coordinated timing means pension system failures will compound rather than offset each other's economic impacts. When multiple large pension systems simultaneously reduce benefits, increase contributions, or require taxpayer bailouts, the economic consequences exceed what individual system failures would create separately. The mathematical inevitability of widespread pension system failure within the next decade creates economic and political pressures that current institutional frameworks cannot manage effectively. When millions of workers discover that pension promises cannot be kept because the mathematics no longer work, the social and political consequences will exceed anything experienced during previous financial crises. Understanding pension system failure as mathematical certainty rather than policy choice provides insight into why preparation for pension system breakdown represents prudent planning rather than pessimistic speculation. The arithmetic is clear, the demographic trends are irreversible, and the investment return environment makes traditional pension mathematics impossible. The day pension funds realize they had no money represents mathematical reckoning that cannot be postponed indefinitely through accounting conventions or political promises. When the fundamental arithmetic supporting pension systems becomes impossible, the systems stop functioning regardless of institutional quality or political commitment. The mathematical reality underlying pension systems has changed irreversibly, while the promises based on outdated arithmetic remain unchanged. This mathematical impossibility guarantees that pension promises will be broken either through formal system failures or through benefit reductions and contribution increases that achieve identical effects. When the math stops working, the promises become lies, told by institutions that cannot admit mathematical impossibility because acknowledging arithmetic reality would require confronting political consequences that exceed institutional capacity for honest communication. The mathematical reckoning proceeds regardless of institutional acknowledgement, making pension system failure inevitable rather than avoidable. Illinois. Teachers' retirement system discovered what thousands of pension systems worldwide are simultaneously learning. Decades of promises based on mathematical assumptions that no longer reflect economic and demographic reality have created obligations that cannot be met regardless of investment performance or political determination. The mathematics have changed, but the promises haven't, creating arithmetic impossibility that makes pension system failure mathematically certain rather than merely probable.